there's a lot of symptoms that we're in a bubble. So, for example, the S&P 500's equity risk premium is now, last we looked, it was zero. It must be negative now. So the last time that happened was the tech boom. We've seen this massive investment into data centers. I mean, we've seen what happened with Oracle, where its share price has just flown, and really these are about promises for future investment, and it could come, but really it's from one client, it seems, mainly OpenAI, and its share price has just flown. And this reminds me personally a lot of the dark fiber boom during the tech boom, and a lot of the dark fiber companies land up going bankrupt. Now, we're not saying the same thing's going to happen with these data centers, but we are seeing massive investment into what is essentially a commodity-style business, and that generally doesn't end well. And it's going to be increasingly fueled by low negative real rates. And again, all these things are very dangerous. So Pella is concerned. We're aware of this, and we're aware of what happened to funds that many funds that became over exuberant about it during the tech boom. And a lot of them just lost a lot of money. So we're taking a more defensive stance. But yes, being equity investors, we're always naturally long duration, but we're being very defensive in our approach.
All right, sounds wise to me. Listen, how are you reading Japan? Because the cost of money, if the Fed, whether 75 or 100, if rates are going to be continuing to go down, this is happening at a time when Japan is trying to push rates the opposite direction, that is up.
Yeah, well, the Bodge is actually probably doing the right thing, because again, their CPI has consistently been above 3%. And their current policy rate is about 0.5%. So the market is expecting another 25 basis point increase this year, which makes entire sense. The more interesting thing of what that means is it could result in a reversal of the carry trade. Well, it should result in a reversal of the carry trade. And what that means is Japanese investors should be taking money out of the US and back into Japan. And still, whilst there is still a positive spread to be investing in the US, it's not as good as it was. So we should see incremental money returning back to Japan. And again, that is a big risk to the tech trade in the US, because a lot of that money from the Japanese carry trade finds its way into the US tech stocks. And so that's another reason we counsel investors to be very aware of the current exuberance in those tech stocks. And an increase in Japanese interest rates is actually not a good thing, as we say, for the US market. So It's just another reason that we think people should be cautious.
Yeah, I hear you. I remember what happened last year, right, with that reversal of the yen carry trade. It wasn't quite an earthquake, but it was certainly a noticeable tremor. So as the U.S. rates go down and Japanese rates go up, expect another leg down in this yen carry unwind. I hear you there. How are you thinking about China? What are you doing with the money in China right now?
We've invested quite a lot in China. We've got about 10% of our funds in China, which is it doesn't sound massive, but it's well above its weight in the benchmark, and we're very underweight the US. But we've still got more money in the US than China, but we're underweight the US. Now, the thing with China is stocks are just very cheap. They're not as cheap as they were, but they are very cheap. And the government has definitely demonstrated a willingness to allow share prices to increase. And really, that's what you need in China. It's extremely policy driven. And the government seems to be aware of the issues and seems to be doing a lot of positive things to allow capitalism to thrive once again. So we certainly wouldn't bet the farm, but we do think China is a worthwhile place to invest. We've invested in more consumer-facing names there, companies like Medea and also Anta Sports. But we also own Cattle, which, as you know, is the world leader in EV batteries and lithium batteries, and has been a wonderful investment since its Hong Kong IPO. Finally, we hold AIA, which is a life insurer in China, which is very cheap and is very well run. Again, consumer-facing. So we believe there are reasons to invest in China. The stock prices are cheap. The government are doing things to allow capitalism to do a little better than it was allowing before. and we think it's a place that's really worthwhile looking at and will benefit if money flows out of the US.
Yeah, just for the record there, the folks over at CATL prefer us to say CATL. They don't take kindly to their stock or their company being called cattle, although it's a good laugh.
Yes.
But listen, anyway, I'm wondering, you were just saying, Stephen, that you think there's, on the part of authorities, a willingness to let stocks in China rise further. Does that willingness extend to following the Fed and cutting rates further? They will be under pressure to do so, but there is a risk there that by doing that, they could be throwing fuel on the fire. I mean, this market is still cheap. Yes, I would agree, but it's also been pretty exciting.
Yes, it has. There would be pressure on them to cut rates just because of their peg to the US dollar. So there could be pressure on them to cut rates. The bigger issue, the bigger thing with China is the fiscal policy, and what we really need to see, as you know, is some improvement in the housing market. Now, will cutting rates help the housing market? Yes, perhaps at the margin, but what we really need to see is a clearing out of the excess capacity in the Chinese housing market. Lower interest rates would help. What would really help is if the Chinese government actually bought a lot of those houses and used it for social housing. So that's something we're watching very closely. And yes, that would pour fuel on the fire, but there's a long way for that market to go to really recoup where it should be.
Steve, a quick last one for you. This is on China EV names and makers. I mean, obviously, the authorities are trying to do triage on the sector, right, to try and limit, which is what's becoming, I don't know, just too cutthroat for them, right? For the big ones who are able to have the scale and have, I guess, the pricing power, their way out is to basically send that capacity and their cars and those EVs outbound to places like, let's say, Europe or Central Europe, right? Are those the names that you prefer, or are you staying clear of that sector altogether?
We are staying clear of the sector at the moment because there is excess, there are the issues you refer to in China, and that's where they're currently making most of their money. They will obviously export to other countries, and obviously we're seeing a huge growth in that. But we are very concerned about the current situation in China and with the automobile sector, and we do expect consolidation. So an interesting way to play it might be to look for good companies that are actually struggling a bit and are likely to be acquired. But of course, one has to be careful. You don't want to buy one of those that go under. But we are waiting for more consolidation in that market and just a bit of a pullback before we go in, because these cycles can last longer than anyone expects. And we're actually just started some kind of slowdown or clamp down in the Chinese automobile market. Of course, they will grow internationally, but that's really more of a bad thing for the European OEMs than necessarily a great thing for the Chinese OEMs, because there's a lot, just because of the fact that China makes such a big part of their sales at the moment.